So the Reserve Bank of India left interest rates unchanged. The repo rate was at 8%, it continues to remain there. That is not a surprise. What has changed though is the RBI's expectation for inflation. While 2 months ago the RBI was still forecasting inflation to remain at 7% next year, now they expect inflation to soften to about 6% next year. And the risk to that 6% view is now seen to be evenly balanced, where they expected an upside risk to inflation next year. What that means is RBI now sees scope for monetary easing or a change in the policy stance early next year. This is very significant. This means that RBI has now opened up the possibility of rate cuts. And more importantly, that once these rate cuts start, further actions would also be guided by that policy stance, which is to say, we can expect a series of softening measures over the course of the next year or more. Now, of course, lower yields means higher prices for bonds. We have already seen that for most of the last 3 to 6 months. This is before the RBI has even taken its first step towards cutting rates. So it's our expectation that if RBI delivers on these rate cuts that it has indicated today, you will continue to see bond yields fall and prices rise. This portends good news for bond markets, and you should see bonds continue to outperform over the course of the next year to two.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.